Hello and welcome to Explain the Charts. Today is May 1st, 2026, and the Bitcoin market is at a massive crossroads following a week of heavy economic data. The primary driver right now is the Federal Reserve's decision on Wednesday to hold interest rates at 3.5 to 3.75%. This was a historic meeting, representing Jerome Powell's likely final act as chair, and it was marked by a fractured 8-4 vote. The market is clearly nervous about this lack of consensus, especially as the U.S. 30-year Treasury yield just hit 5%. When yields are this high, risk assets like Bitcoin often face major headwinds as capital flows toward safer, high-interest returns. Additionally, escalating U.S. and Iran tensions have pushed oil above $110, adding inflationary pressure to the global economy. Despite this, institutional players like Satsuma Technology continue to stack sats, recently purchasing over 22 Bitcoin for their treasury. We are seeing a massive battle between institutional accumulation and macroeconomic pressure near the $80,000 mark. Let's jump into the daily chart to see how this historical context is playing out in the price action. If we look at the daily chart for BTCUSD, we can see the incredible journey Bitcoin has taken over the last year. The market reached a monumental all-time high of $126,210 back on October 6, 2025. However, that peak was met with extreme profit-taking, leading to a massive flash crash just days later. On October 10, 2025, Bitcoin plummeted from over $121,000 to a wick low of exactly $100,000. That drop of over 17% in a single day was a wake-up call for the bulls and established a heavy resistance zone near the top. After that crash, Bitcoin spent months consolidating and slowly grinding lower as interest rates began to bite. This led us into early 2026, where the market searched for a definitive floor. The daily candles show that every attempt to rally back toward the six-figure mark was met with significant selling pressure. It is clear that the 2025 cycle top left many retail investors underwater, which has created overhead supply. We need to examine the recent 2026 bottom more closely to understand our current support levels. Focusing on the first quarter of 2026, we saw the most dramatic drop of the year on February 5th. Bitcoin fell from an open of $73,000 to a staggering low of $59,930. This 14% drop in 24 hours finally flushed out the remaining weak hands and created a rock-solid floor. Since that February low, we have seen a series of higher lows, which is a classically bullish structural signal. The recovery from 60,000 back to the mid-70,000 range was gradual but steady. During this period, correlations with gold and oil were high, suggesting Bitcoin was being used as a hedge against geopolitical risk. However, as we approached the $78,000 to $80,000 range, the momentum began to stall. The daily candles in late April show a lot of indecision, characterized by small bodies and long wicks. This brings us to the current struggle we are witnessing as we enter the month of May. Let's look at the hourly data to see the specific price action from the last few weeks. Looking at the 1-hour chart from mid-April, we can see the attempts to break the range-bound movement. Bitcoin managed to climb from $71,000 on April 10th to nearly $74,000 by April 13th. This rally was driven by short-term optimism ahead of the Fed meeting, but it was quickly capped. Notice how every time the price reached $73,000, sellers stepped in aggressively to push it back down. The volatility during these sessions shows that traders are scalp trading the range rather than holding for a breakout. This type of choppy action is typical when the market is waiting for a major catalyst, like the Powell exit news. The volume bars during these hourly surges were relatively low, which usually indicates a lack of institutional conviction. We can also see a clear support level at $70,800 that held multiple times. But as we moved into the final week of April, the range expanded significantly. Let's zoom in on the last few days using the 15-minute chart for a more granular view. On the 15-minute chart for late April, the battle at the local top becomes very apparent. On April 27th, Bitcoin made a valiant run toward the local peak of $79,528. This is currently our primary resistance level that bulls must clear to target 80,000. Immediately after hitting that peak, we saw a sharp reversal, sending the price back down to the 76,000 area. The rejection at 79.5K was fast and high volume, suggesting a wall of sell orders at that level. By April 29th, the price had drifted down to a local low of $74,912. This low coincided with the Fed announcement, showing the immediate knee-jerk reaction to the hawkish hold. The market didn't like the uncertainty of the fractured FOMC vote, leading to a quick stop run below 75,000. However, the dip was bought up fairly quickly, and we've stabilized near $76,300. The 15-minute candles are currently forming a narrow consolidation pattern, which usually precedes a breakout in one direction. If we stay above 76,000, we could see one more attempt at the $80,000 psychological level. But a break below 75,000 would likely trigger a test of the lower weekly support zones. The correlation between the 5% yield and this rejection cannot be overstated. Traders are clearly waiting for a signal that the rate hiking cycle is truly over before committing to a breakout. Let's head back to the daily view to summarize our key levels and predictions. To recap, the key resistance to watch is $80,000, with the most recent rejection at $79,528. On the support side, $74,900 and $76,000 are our immediate lines in the sand. Below that, the massive structural support from the February floor sits way down at $60,000. For an unbiased prediction, I believe a short-term sideways consolidation or minor correction is the most likely scenario, with a 60% probability. This is because the combination of 5% yields and a fractured Fed makes it very difficult for Bitcoin to find new buyers at these levels. However, if the geopolitical situation worsens and oil continues to climb, we could see a flight to safety surge above 80,000. I would give that bullish breakout a 30% probability in the next 2 weeks, provided we close a daily candle above 79,500. The remaining 10% probability is a sharp correction back toward 68,000 if yields continue to climb towards 6%. Keep a very close eye on the transition to the new Fed leadership, as any hint of dovishness will be the fuel for the next leg up. Watch for rising volume on any breakout attempt to confirm that the big players are finally stepping back in. This has been your in-depth analysis on Explain the Charts. As a reminder, this video is for educational purposes only and is not financial advice. The crypto markets are extremely volatile, so please do your own research and manage your risk before making any investment decisions. Thanks for watching, and we will see you in the next chart analysis.